I guess there are two reasons that revenue forecasts are important. One on the negative side and one on the positive side. On the negative side, if you're building forecasts, you're making promises to somebody, let alone yourself. You're making promises to investors or someone like that. So if you build a plan that says you're going to take the company to $10 million and you're going to use $5 million to get there, if your revenue forecasts are wrong and it's going to take you more than 5, you're likely to spend your 5, run out of money, need more, but the next time the investors say, well, you didn't deliver what you said you were going to deliver, so I'm not going to, first of all, believe your next forecast. And secondly, I'm going to pay less for my shares now because you ran out of money for the first time. So if you're careful about how much you plan to do with what you're getting, you won't disappoint people and end up disappointing yourself. The worst thing that can happen, of course, is that you get money from investors, you spend all that money, get nowhere, and go out of business because your forecasting was wrong. On the positive side, if you know what your revenue is going to be for the next few years, it's a lot more likely that you're going to be profitable or that you're going to reach positive results than if you don't know. If you can imagine Boeing or major companies like that, they know what the revenue is going to be for the next 5 years or so. And in that case, it's a lot easier to be profitable if you know exactly what your revenue is. And getting back to why they're important, it's that knowing what your revenue is going to be stops you from making the mistake spending too much money and gives you a chance to be profitable. So before you build forecasts, there are a couple of things you need to know, and they're all related to your market. You really have to have an understanding of who your target market is, why your target market is going to buy, how they buy, how long it takes for them to buy, because without that knowledge, it's impossible to build realistic forecasts. Understanding the process in which they go through allows you to figure out what you need to do, how many leads you need to get, how many proposals you need to do to be able to actually generate sales, and how long it takes between a lead and the eventual sale will allow you to determine what effort you need to be putting in, how much money you need to raise, all sorts of other things that without an in-depth understanding of your market, their buying behavior, their actions, etc., you just won't be able to produce realistic forecasts. Investors fall into a whole bunch of pitfalls when they're looking at forecasts. The first pitfall they fall into is believing Gartner and Frost & Sullivan and Forrester, great companies producing great research, but the tendency for entrepreneurs is to say, the market is $12 billion and I'm going to get 1% of it. So the first pitfall to avoid is believing that you can get a certain percentage of a market. You really have to understand what market you're going after to avoid that pitfall and how few people there might be in it and be able to address them properly. The second problem to avoid is when you're doing forecasts, don't start with a revenue plug. And a revenue plug is where you're preparing forecasts and you say, okay, sales in the first month are going to be $100,000. Sales in the second month are going to be $200,000. That revenue number isn't built upon anything. So there's nothing backing it up. It's just a simple plug. And avoiding these gross generalizations and understanding your market stops you from making these type of mistakes that are typical of entrepreneurs. So there are two ways of preparing forecasts. The first is a top-down way. And in a top-down way, you've got to understand your market and how your market is going to come to fruition over time. First is understanding the depth of your market. How big is your actual market? You have to actually figure out how many companies there might be or how many individuals have the particular need you're trying to meet and how many of them might come to buy over time. Second thing you've got to figure out from knowing how many there are is how fast is that market going to take to reach realization. Most markets can take 20 to 30 years until you've reached fully all the companies in the market. If you know how many there are and how fast it is to get to that market, you can figure out what the ramp of market size is going to be. And the next question is what market share you're going to get. So understanding your market share, for instance, you've got $5 million to spend on marketing and your competitors have $20 million to spend on marketing, you might get an appreciation that you're not going to beat them out in all likelihood in the marketplace. The combination of those three factors allows you to figure out a top-down approach to calculating what your revenue is going to be per year over the next several years. The bottom-up approach to forecasting a market is very granular. It starts with the understanding of your sales funnel. the fact that you've got to take a customer from a lead to some sort of discussion, to a proposal, to an evaluation, to a trial, finally to the point in time they order, and then you install. So understanding the process that your customer goes through allows you to figure out how long it's going to take to go from, say, a lead to a discussion to a proposal. And secondly, what percentage of customers you're going to be able to take from a lead to a discussion to a proposal. If you look at it overall, you might be doing well if you can convert 5% of your leads into actual sales, and doing very well if you can do that, for instance, within a year. So if you understand your sales funnel and from a bottom-up approach, it'll allow you to understand when you might be able to get revenue and what you have to do at each stage in order to drive that revenue.